Where do biotech companies get the money to keep researching cures for diseases? Well, most of the time from stock offerings. But what exactly are they? How do they affect the share price? How should we approach them? What should we pay attention to? Today we are going to analyze past behaviors to learn and be ready for the future. And what will happen to GYRE and CytomX after the recent stock offerings? Wait until the end and let's find out in today's video. Welcome to Taxi Biotech, a program to learn about news and developments in the world of biotechnology and to understand its impact on the stock market. The stock data shown here reflects how companies or their clinical trials are progressing and is not investment advice. This is purely entertainment. Today we are starting in a Turkish bazaar, buying and selling shares, company main offers and discounted deals for institutional investors. Will we get a good deal? Let's go! Let's put this into context. Biotech companies need massive amounts of funding, especially to advance through clinical trials. So where does that money come from? In many cases from going public and selling shares in exchange for a piece of the company. But eventually that money runs out, and at that point the CEO and the CFO sit down and ask themselves, what tools do we have left to raise more funds? One of the quickest and most common options is doing a stock offering. They simply create more shares and sell them into the market. That's how they get new money to keep going. But here's the issue. More shares in circulation means each share is worth a smaller piece of the pie, so dilution. That usually puts downward pressure on the stock price. That's why capital rise stock offerings are often announced right after good news to balance out the negative impact with a positive catalyst. So, what should we look for in a stock offering? First one, is it tied to positive news? Sometimes the news is strong enough to offset the dilution effect. That's why it's crucial to see if there is a meaningful announcement here attached to the stock offering. Number 2. What percentage of new shares are being issued? A 2 to 5% increase in share usually is not a big deal. A 30% increase? That's a whole different story. Number 3. At what price are the new shares offered? If they are sold at a discount to the market price, that can drag the stock down. If they are offered at the same times that the stock market reflects, it's a neutral signal. But if they are offered at a premium, that can signal management's confidence. Last one. Are institutional investors participating? Their involvement is a big vote of confidence and often helps the price hold up. So, we'll go through these 4 factors using real examples from past stock offerings. In the chart I show, first one, I highlight the news, and the second one, the percentage of new shares being issued. The charts, the offering price will be marked with a blue line. The last one, if institutional investors are participating, you'll see a green flag. It's important, the timing. A big red arrow will mark the moment when both the news and the stock offering are announced. But sometimes they don't happen at the same time. Sometimes it's just one or the other. If they happen at different times, the news will be marked with a red arrow and the capital rise, the stock offering, will be marked with a dashed red vertical line. So that we have the context, let's take a look at the chart. First example, Nuvalent. The company released oncology-related news. Phase 1 dose escalation, start of Phase 3, new patients enrolled in Phase 2. It's solid news, especially the Phase 3 initiation, but nothing disruptive. Still, the stock jumped 15%, and at the same day, they announced the stock offering. Let's break it down. They had 65 million shares outstanding. They plan to add 5 million more, just 3.7% dilution. No institutional investors involved. No green flag here. Offering price equal to the stock price that day, so neutral with this blue line indicating $100 per share. Result, with this news and these conditions, stock stayed in sideways range for about a month. As always, you'll find this link to a press release, filings and financial reports in the comments below if you want to check them out yourself. Next example, Vaxcyte. They published positive phase 1-2 results for their pneumococcal vaccine. Good data overall. They announced they would be selling 10% of their outstanding shares. Not a massive dilution, and the offering price was about 5% below the market price. Not bad. The result, the price held up reasonably well and only started dropping gradually after 2 months. Next example, Pharvaris. They presented very strong phase 2 data for hereditary angioedema and their prophylactic pill. Scientifically, it's excellent and the stock jumped 60%. That same day, they announced a stock offering. Offering price, it was a fair value, same as that day's trading price. Institutional investors were involved with this green flag, but they were offering over 30% of their existing shares. Despite that, the stock held about the $24 offering price for several months. Lessons here is not just the percentage of dilution that matters, it's the whole picture. Next one, Immunovant. They share positive phase 1 results in healthy volunteers for an autoimmune disease. The news itself was average, but the stock jumped 50% in one day, not bad. The next day, stock offering announced. Institutional backing, very important, mark here with the green flag. It was priced at a fair price with no discount and only 6.5% of dilution. Result in the stock price is that the stock held up very well for several months. Takeaway here, low dilution, institutional support give price stability. Next sample, Solid Bioscience. Positive phase 1-2 results for a gene therapy. Stock rise another 50%. The same day, a stock offering announced with institutional participation here, but they are issuing 50 million new shares, and they only had 77 million in circulation. That's major dilution. The price held briefly but dropped back to pre-announced levels within a month. It's like the 2x rise here in price got wiped out by the 50% dilution. Even with the institutional support, that kind of dilution is hard to absorb. Example, BioXcel Therapeutics. The FDA finished its manufacturing site inspection and the result was favorable. Just some voluntary actions required. The stock skyrocketed 200% on the news. Same day, stock offering appeared. With fair pricing, so it's okay. They offer 4 million new shares and only 5 million were previously outstanding, so that's a 50% dilution. Price obviously drop. Example, Enveric Bioscience. They announced a new patent approval. Personally, I don't find patent news all that exciting, but they use it to justify a stock offering. They offer over 3 million new shares and they only had 1.2 million before. That's a 260% dilution. The result, the stock plummet. Is no escaping that kind of dilution. Later, the offering price itself acts as a resistance level for the stock. This is common. Next one, Aptevo. They announced that 2 more leukemia patients went into remission. The market didn't react at all. And 15 days later, here, they announced a stock offering more than 100% of their shares. As expected, the stock dropped a lot. Next example, Apellis Pharmaceutical. They received approval for a drug, a huge milestone for the company. and the stock jumped 25%. 2 days later, they announced a stock offering. Offering price was equal to the stock price that day. This is a good sign. And only 5% of dilution. Very good sign. Perfect example of how to do it right. Low dilution, well timed, and market friendly with fair price. Stock held the offering price well and continuing moving up. Next one, TransCode Therapeutics. They spoke with the FDA and were allowed to add a new cohort to their phase 1/2 trial. The market didn't take it as a major news, and a few days later they announced a stock offering. Price was fair, no institutional participation, and 44% of dilution. The result, the stock fell hard and never even got close to the offering price. Example, Sana Biotechnology. The FDA gave them permission to start a new type of therapy. Not huge news, but not bad either. Shortly after, here marked with the dash line, they announced a stock offering, issuing 15% more shares at a discounted price, likely to guarantee funding. The stock never dropped here to that discounted level. Instead, it spiked days later. So lesson here, a discount rise doesn't always feel or cause a drop. If dilution is under 15%, the market can digest it, especially if timing aligns. Obviously, additional news could sustain these price movements. Now, 2 ongoing cases. What will happen with CytomX? They shared phase 1 dose escalation results for colorectal cancer. To me, the news wasn't amazing, but the stock jumped 60%. Then came the stock offering. Institutional investors involved. This is a strong support, but they are offering almost as many new shares as currently exist, 50% of dilution. An offering price is 60% lower than the current price. For now, institution seems to be holding the price, but honestly, what do you think? Drop it in the comments. From what we've seen, that's too much dilution to hold for long. My bet, we'll see a correction in the future, but hey, this is just my opinion. And the last one, GYRE Therapeutics. This one, I was in it, and I said on Twitter, the market misunderstood the news, and I entered around here, $7. It was already known that they released phase 3 results for China, and they did, strong results. After that, stock offering, but only 2.7% of dilution, and at fair price. The result, the stock rebound yesterday. That 2.7% is small, and the data is solid, although yes, it's just for China. Now they need cash to launch that study in the US, and that's why they raise funds. I won't lie, I got nervous here, but the numbers speak clearly. My current strategy, I'm selling my position and looking for the next opportunity. I'll share it right here, so make sure you subscribe to this channel. So, let's recap. Good news drives stock price up, obviously, and that's when companies take the opportunity to do a stock offering. We need to watch the percentage of new shares issued. Under 15%, usually well accepted. The offering price matters. If it is fair or just slightly below the market price, investors usually respond well. And the most powerful factor? Institutional participation. If pros are in, the price tends to hold up much better than if they are not. That's it for today's journey. I hope this helped you learn something new about stock offerings in biotech. Now it's your turn. Thanks for watching and see you next time. Goodbye.